Mid-year is the perfect time for a financial health check, but most therapists are missing critical opportunities that could save them thousands. After studying what separates financially successful therapy practices from struggling ones, I've identified 7 things that high-earning practices do in their mid-year reviews that others are completely ignoring. If you're a Canadian psychotherapist who wants to optimize your practice finances and stop leaving money on the table, this video is for you. My name is Toyin. I'm a chartered professional accountant, money coach, and financial planner. I also have an MBA. I've spent thousands of hours helping people with their money and business. And I specialize in working with mental health professionals across Canada. The first thing you absolutely must check is your quarterly tax payments. If your practice has grown since last year, and according to industry data, most successful therapy practices grow 15 to 13% annually. You're probably underpaying your quarterly investments right now. Here's exactly what happens and why it's so costly. CRA bases your quarterly payment requirements on your previous year's taxes. So if you made $120,000 last year and you're on track to make $180,000 this year, your quarterly payments will be based on that $120,000 figure. Come tax time, you would owe a massive lump sum that could easily be between $15,000 to $20,000 or more. Let me walk you through the math. Say you made $120,000 last year as a sole proprietor in Ontario. Your total tax bill was probably around $35,000 to $40,000 when you factor in federal tax, provincial tax, and CPP contributions. CRA wants you to pay that in 4 quarterly installments of about $9,000 each. But now, you're making $180,000 this year. That's $60,000 more in income. As a sole proprietor, you pay roughly 45 to 50% tax on that additional income when you factor in the marginal tax rates. That's an extra $27,000 to $30,000 in taxes you owe. If you don't adjust your quarterly payments, you get hit with this entire amount plus interest and potentially penalties. The interest rate on late or insufficient payments could come to over 10% annually. Here's what you need to do right now. Calculate your year-to-date income and multiply by 2 to estimate your full year income. If it's more than 10% higher than last year, call CRA immediately and request to increase your quarterly payments. Yes, it hurts your cash flow now, but it prevents that devastating surprise bill later. Second, you need to conduct a thorough audit of your expense tracking. Mid-year is the perfect time because you have 6 months of data to analyze patterns, and there's still time to implement better systems for the rest of the year. Most therapists are leaving thousands of dollars on the table in legitimate business deductions. Let me break down the biggest categories you need to review. Home office expenses are massive and consistently underclaimed. If you're using a dedicated room or area of your home exclusively for your practice, you can deduct a percentage of your home expenses. Here's the detailed calculation. Measure your office space and divide by your total home square footage. If you're using 200 square foot of a 2,000 square foot home, that's 10%. Now, apply that percentage to your utilities, property taxes, home insurance, mortgage interest, if you own, and home maintenance costs. On a typical Canadian home, this could be $4,000 to $7,000 annually. But you need to track these expenses monthly and keep detailed records. Professional development expenses go way beyond just conference fees. Every workshop, seminar, online course, professional book, journal subscriptions, and continuing education requirements is deductible. But here's what most therapists miss: the associated costs. Hotel stays for conferences, meals during training days, travel costs to workshops, parking fees, even the professional networking dinners after conferences. If you attended a 3-day conference in Toronto, you can deduct not just the $2,000 registration fee, but also your hotel costs, 50% of your meal costs, your flight or mileage, parking, and grant transportation. That could easily add another $1,500 to $2,000 in deductions that many therapists forget to claim. Technology and equipment expenses are huge in today's digital therapy environment. Your practice management software subscriptions, secure video conferencing platforms, professional-grade computer equipment, ergonomic office furniture, specialized therapy apps, cloud storage services, website hosting, online scheduling systems. All of these are legitimate business expenses. But here's the key. Don't just dump everything into a generic office expenses category. Proper categorization is crucial for two reasons. First, it helps you understand where your money is actually going so you can make better business decisions. Second, if you ever face a CRA audit, detailed categorization shows you're running a legitimate business and taking proper care with your record keeping. Professional fees and insurance costs are another area to review. Your professional liability insurance, association dues, licensing fees, college registration costs, continuing education requirements. Track all of this separately. Many therapists let their bookkeepers categorize this generically, but professional fees are often subject to different tax treatment and should be tracked specifically. Marketing and advertising expenses are often overlooked by therapists who think they don't do any marketing. But your professional website costs, business cards, networking event fees, professional photography for your website, even your LinkedIn Premium subscription, if you use it for professional networking. These are all legitimate business expenses. Third, start your year-end tax planning now. This separates financially successful therapists from those who scramble every December and miss opportunities. Equipment and technology purchases require strategic timing. The Canadian tax system allows you to deduct capital assets in the year you purchase them, subject to certain rules. If you're planning to upgrade your office furniture, computer equipment, or therapy-specific technology, the timing of these purchases can significantly impact your tax situation. Here's a practical example. Say you need a new laptop, office chair, and some furniture upgrades totaling $5,000. If you buy this before the year end, you can claim the full depreciation deduction for the entire year on most of these items. But if you wait until the following year, you won't get any deduction until the next tax cycle. For bigger purchases like major office renovations or expensive equipment, you need to understand the capital cost allowance rules. Some items can be fully deductible in the year of purchase, while others must be depreciated over several years. Income timing strategies become crucial as your practice grows. If you have clients who typically pay outstanding invoices in December, consider whether it makes sense to delay sending those invoices until January. This pushes the income into the following tax year, which might be beneficial if you're expecting a lower income year or if you're planning to incorporate. For example, if you're sole proprietor planning to incorporate next year, having lower personal income in your final year as a sole proprietor and higher corporate income in your first year of incorporation could result in overall tax savings. Therapists who have already incorporated, mid-year is when you need to start planning the optimal salary versus dividend mix. This is complex because it depends on your total corporate income, your personal income needs, your spouse's income situation, and your retirement and saving goals. The basic principle is that salary creates RRSP contribution room and is generally tax deductible to the corporation, while dividends are paid from after-tax corporate income, but receive dividend tax credits personally. The optimal mix changes based on tax rates, income levels, and personal circumstances. If you're incorporated and taking only dividends, you might be missing out on RRSP contribution room. Conversely, if you're taking a high salary you might be paying more total tax than necessary. This requires detailed analysis of your specific situation. Retirement savings planning should also start now. If you're self-employed, you don't have an employer pension plan, so your RRSP contributions become crucial. But the contribution room is based on your previous year's earned income, and there are complex rules about what counts as earned income for self-employed individuals. If you're incorporated, you need to consider whether it makes more sense to take salary to create RRSP room or to leave money in the corporation and invest it there. Corporate tax rates on investment income are generally higher than personal rates, but you get tax deferral benefits. Fourth, conduct a thorough analysis of your cash flow patterns. Most therapy practices have predictable personal variations that you can plan for if you understand them. Summer months often see reduced client loads as people go on vacation, kids are out of school, and schedules change. Fall typically brings a surge of new clients as people get back into routines. Understanding these patterns helps you plan both operationally and financially. Look at your monthly revenue for the first half of this year compared to the same period last year. Are you ahead, behind, or tracking similarly? If you're significantly ahead, congratulations. But are you saving enough for taxes? If you're behind, you need to understand why and create a plan to address it. Calculate your average monthly expenses and compare them to your average monthly revenue. Successful therapy practices typically maintain at least 3 to 6 months of expenses in a business emergency fund. If you haven't built this cushion yet, mid-year is the right time to start. Here's a practical framework for cash flow management. Financial experts recommend saving 30% of your gross revenue immediately for taxes and business expenses. This might seem high, but it covers your income taxes, CPP contributions, and business expenses. If you're making $15,000 per month, $4,500 should go into a separate business account immediately. Track your key performance indicators monthly. What's your average revenue per client? How many new clients are you attracting each month? What's your client retention rate? Are your rates keeping up with inflation and your growing expertise? If you're seeing 20 clients per week at $120 per session, that's $2,400 per week, or about $9,600 per month, assuming 4 weeks. But what happens if you lose 2 regular clients? Your income drops to $8,640 per month. Understanding these numbers help you make informed decisions about rate increases, marketing investments, and business development. Fifth, evaluate the return on investment of your professional development activities. You're required to complete continuing education, but successful therapists are strategic about their choices. Create a spreadsheet tracking every training, workshop, conference, and course you've completed this year. Include costs, time investments, and most importantly, the practical impact on your practice. Did the training allow you to serve clients better? Did it justify a rate increase? Did it help you attract a new type of client? For example, specialized trauma therapy training like EMDR that costs about $3,000 and requires significant time investment often allow therapists to increase their rates from $120 to $140 per session. That $20 increase pays for the training cost in just 150 sessions. If you see 20 clients per week, that's less than 2 months to recover your investment. But what about general business workshops that cost several $100s but don't really change how you practice? Maybe you should skip similar general training and focus on specialized clinical skills that directly impact your service delivery and rates. Professional development also affects your taxes significantly. All legitimate continuing education is fully tax deductible, but you need proper documentation. And keep receipts, registration confirmation, certificates of completion, and notes about how each training relates to your practice. Consider the timing of your training investment too. If you're having a high income year, accelerating professional development expenses into this year might make sense from a tax perspective. Sixth, review all your insurance coverage and professional fees. As your practice grows and evolves, your insurance needs change as well. Professional liability insurance is non-negotiable. But are your coverage limits appropriate for your current practice size and client load? If you've grown from seeing 10 clients per week to 15 clients per week, your risk exposure has increased significantly. Review your coverage for different types of services. If you've added couples therapy, group sessions, or online therapy to your practice, make sure you are properly covered. Some policies have specific exclusions or limitations for different service delivery methods. Business insurance becomes more important as your practice assets grow. That expensive computer equipment, office furniture, and specialized therapy materials represent significant value that should be protected. Disability insurance is crucial for therapists because your ability to earn income depends entirely on your ability to work. If you become unable to practice due to illness or injury, disability insurance replaces your income. As your income grows, you need to ensure your coverage keeps up. Professional association dues, licensing fees, and regulatory costs should be tracked carefully. These are fully deductible business expenses, but they also represent the cost of maintaining your professional standing. Budget for increases in these fees and consider them when setting your rates. Finally, assess whether your current business structure still serves your financial goals. This is particularly important if your income has grown significantly. If you're currently a sole proprietor and consistently earning over $150,000 annually, incorporation might save you thousands in taxes. But incorporation isn't just about tax savings. It also creates additional administrative costs and complexity. The break-even point for incorporation varies by province and your specific circumstances. But generally, if you're making over $150,000 and can afford to leave some money in the corporation rather than taking it all as personal income, incorporation starts making financial sense. Incorporated practices also open up additional tax planning opportunities like income splitting with family members, more flexible retirement planning options, and better protection of business assets. However, incorporation also means additional costs for corporate tax returns, potentially more complex bookkeeping, and additional regulatory compliance requirements. These 7 areas represent the difference between therapists who build wealth through their practices and those who just get by. The financially successful ones treat their practice like a business and make strategic financial decisions throughout the year, not just at tax time. Remember, every dollar you save in taxes through proper planning is a dollar that can go towards building your emergency fund, investing for retirement, or growing your practice. If you want to dive deeper into maximizing your business deductions, check out my video, The Complete Guide to Canadian Psychotherapist Tax Deductions, where I break down every deduction category with specific examples and documentation requirements. See you in the next video.